The aim of this unit is to gain an understanding of financial accounting techniques. Learners will develop practical accounting skills to enable them to prepare final accounts for a range of different business organizations, and will understand how to analyze and evaluate these statements, making appropriate justifications for organizational improvements. Preparing final accounts for sole traders encompasses several key steps and involves understanding specific accounting principles. To address this learning objective thoroughly, we need to delve into the theoretical frameworks, practical steps involved, and the underlying principles governing these practices. Accrual basis of accounting. This principle states that income and expenses should be recognized when they occur, not when cash is exchanged. This affects how transactions are recorded in the final accounts. Going concern. Concept. This assumes that the business will continue operating in the foreseeable future, which influences the valuation of assets and the structuring of the accounts. Prudence concept. This principle dictates that expenses and liabilities should be recognized as soon as possible, but revenue should only be recognized when it is certain, thereby ensuring that the final accounts do not overstate the financial position of the business. The final accounts for a sole trader typically consist of two primary components, the trading account and the profit and loss account. The trading account is used to calculate the gross profit or loss of the business. Gross profit is calculated as net sales minus cost of goods sold. Net sales represent the revenue from sales minus returns and discounts. Cost of goods sold includes all the direct costs attributable to the production of the goods sold by the company. This account provides a summary of all incomes and expenses not accounted for in the trading account, resulting in the net profit or loss for the period. Incomes might include interest received, rent from property, etc. Expenses typically include administrative expenses, financial costs like interest on loans, and selling and distribution expenses. The balance sheet is a snapshot at a particular point in time showing what the business owns, assets, what it owes, liabilities, and the value of the owner's equity, capital, and reserves. The balance sheet equation is assets equals liabilities plus owner's equity. For illustration, let us consider a hypothetical scenario where a sole trader's financial activities need to be documented. The trader has made sales worth £150,000 with a cost of goods sold amounting to £90,000. And incurred administrative expenses of £20,000 and financial expenses of £5,000 during the fiscal year. Gross profit equals £150,000 minus £90,000, equaling £60,000. Profit and loss account. Net profit equals gross profit minus total expenses, which is £60,000 minus £25,000, equaling £35,000. Balance sheet, simplified. Assets equal £120,000. Liabilities equal £30,000. Owner's equity equals £90,000. The preparation of final accounts for a sole trader requires meticulous attention to detail and adherence to established accounting principles. It involves summarizing the business's trading activities, calculating profits or losses, and representing the financial condition through the balance sheet. By following these structured steps and adhering to the accounting principles, one can effectively prepare accurate final accounts for a sole trader, providing crucial financial insights into the business's operational results and financial status. To prepare an income statement for a UK marketing organization from specified data, it's important to follow the standard format used in financial reporting, incorporating all relevant revenues and expenses to calculate the net profit or loss for the period. Below, I'll outline a hypothetical example, detailing the common categories and items that might appear in an income statement for a marketing firm. For this example, let's assume the following figures for the fiscal year. Revenue is £500,000 from various marketing services, including digital marketing, branding, and consultancy. Cost of sales is £200,000, which includes the cost of outsourced services, software subscriptions, and direct labor. Operating expenses include administrative expenses of £70,000, marketing and advertising expenses of £50,000, rent and utilities of £30,000, salaries and wages of £100,000, depreciation of £10,000, and other expenses of £20,000. The income statement is structured as follows. Revenue. Total revenue is £500,000. Cost of goods sold is £200,000. Gross profit is calculated as total revenue minus COGS, equaling £300,000. Operating expenses total £280,000. Operating profit is calculated as gross profit minus total operating expenses, equaling £20,000. Net profit before taxes operating profit, equaling £20,000. This statement provides a clear view of the financial performance of a UK marketing organization over a specified period. It demonstrates how revenue is transformed into net profit after accounting for the costs and expenses associated with running the business. The statement of financial position, commonly referred to as the balance sheet, is a fundamental component of a company's financial statements. It presents the financial status of an organization at a specific point in time. This statement provides a structured overview of what a company owns, its assets, what it owes, its liabilities, and the value of the shareholders' investment equity on a specific date. Assets include non-current assets like property, plant, and equipment, intangible assets, long-term investments, and deferred tax assets. Current assets include cash and cash equivalents, accounts receivable, inventory, prepayments, and short-term investments. Liabilities include non-current liabilities like long-term debt, deferred tax liabilities, and pension fund liabilities. Current liabilities include accounts payable, short-term debt, accrued liabilities, and current portion of long-term debt. Equity includes capital, retained earnings, and reserves. The statement of financial position is based on the fundamental accounting equation: assets equals liabilities plus equity. This equation must always balance, as it reflects that all assets are financed either by borrowing money, liabilities, or by using the shareholders' money, equity. This financial statement is crucial for stakeholders, including investors, creditors, and regulatory bodies, to assess the liquidity, solvency, and financial stability of an organization. It provides valuable insights into the company's operational efficiency, financial health, and creditworthiness. Understanding and accurately presenting the content of a statement of financial position is essential for reflecting the true financial status of an organization as of a specific date. This is the first main call-out of the key idea conveyed in this scene. This is the second main call-out of the key idea conveyed in this scene. To prepare an income statement for ATHE Eros Limited, a hypothetical student accommodation provider and service organization, we'll outline a fictional example based on typical revenue streams and expenses associated with this type of business. This will include detailing categories such as revenue from rental income, service fees, and operating expenses. For this example, let's consider the following assumed figures for ATHE Eros Limited for the fiscal year. Revenue includes rental income of £800,000 and service charges of £150,000. Expenses include cost of services of £200,000, administrative expenses of £120,000, utilities of £80,000, maintenance and repairs of £50,000. Salaries and wages of £200,000, depreciation of £40,000, and other expenses of £30,000. Income tax expense assumes a tax rate of 20% on pre-tax income. In conclusion, this income statement provides a detailed overview of ATHE Eros Limited's financial performance over the fiscal year, highlighting the company's ability to generate revenue from its core operations of student accommodation and related services, as well as the significant costs involved in maintaining and managing these services. For the owner of Manchester Electricals Limited, the accurate preparation of final accounts is not merely a routine administrative task, but a critical component of the business's overall health and strategic management. It ensures compliance, aids in operational decision-making, supports effective management of financial risks, and enhances stakeholder relationships. Thus, the integrity of these accounts should be maintained with the utmost diligence to support sustained business success. If you have any questions, please feel free to reach out via WhatsApp or email. Thank you.